Awesome. Excited to see all of you guys. I think we're gonna have people starting to trickle in. Those of you who are joining us, just let us know if you can hear us and see us so that we can keep an eye on that. And we'll get started in a couple of minutes. Awesome. We already got 40 people. Give it a couple of minutes. Let us know where you guys are from. If you guys run a business, share your website. Give us a little bit of context so we can interact with you guys as well. Thank you for joining us on Tuesday afternoon. Hey, Ash, thanks for joining us. Toronto, New York City, there you go. Scent Lodge, I've actually seen that brand. That's awesome. Shop Koi, thanks for joining us from Chicago. Simone, half our team is in Chicago right now because there is a retail conference there. So that's awesome. Brian, I actually had the Living Prana pancakes and waffles this past weekend. They were delicious. Utah, Jamie, Ben, you got a neighbor right here.
A couple, Jamie, Michael. I will
There you
say,
go.
Michael's company Gather, uh, sneakily one of the bigger businesses in direct to consumer. No one talks about them. Uh,
Really?
Portland Leather Goods is cool, but they've got even better leather stuff. My daughter has a little playhouse. The whole thing is a Winnie the Pooh Gather map.
Wow.
If Michael knows all of his products.
Michael, we all got some kids here. Feel free to hook us up. Oh, this is awesome. Really cool site. Well, space amazing. Alrighty, well, looks like there's a lot of you already on here. Let's just start with some intros. Ben, your top left corner, so we're gonna naturally start with you, and then we'll work our way down. And for all of you guys joining us, thanks for joining us for this workshop. I'm gonna go over a masterclass around profitability and exposing some of the silent profit killers, and you'll kind of be shocked. Stay tuned to the end. You'll be shocked at some of the amounts of money we've saved but potentially wasted, and some of these numbers are going to be pretty shocking. So we're going to excited to break it down. But without further ado, let's start with some intros. Ben, if you want to kick us off.
Yeah, so starting in terms of ascending order, in terms of master ability. I know I'm at the bottom. Yeah, so Ben Perkins started And Collar menswear company that sells stretchy dress shirts, and I got invited to do this because Ron was nice and said you worded it really well. You gave the positive spin to it. We've got a lot of learnings. We've wasted a lot of money, but I guess that means I've got my main value comes from I've made every single mistake in the book. So that's why the Chew on this team invited me.
Well, thank you, Ben. You always have the best spirit, and excited to have you on. I'll go next. Ron Shah here, co-founder of Obvi, and work alongside extensively with the ops and finance team to find out if we are wasting or optimizing certain spends and a lot of our processes. And we've been building the brand for about 5.5 years. So similar to Ben, we've also had our fair share of learnings in the more costly way. And luckily, we have great partners in Chargeflow that have paved us into the right direction now. But Dror, I'll kick it off to you.
Thank you very much, Ron. My name is Dror Gazit. I'm the head of customer success here at Chargeflow.io. I'm super happy to be here. And if you're talking about the silent profit killers, unfortunately, you'll have to talk about chargebacks. And as Ron mentioned, here at Chargeflow, we have created the chargeback platform. We're helping merchants to prevent, analyze, and recover chargebacks at scale. Happy to contribute from my experience and our experience to help other merchants make sure that they mitigate that pain as much as they can.
Awesome. Ravi, you want to go?
Yeah, what's up, guys? Name's Ravi Malwani, VP of Finance at Obvi. Pretty much handle everything cash flow management to financial operations to the whole supply chain. Excited to just, kind of teach what we've learned over the last few years of building this. So excited to be here.
Amazing. And thank you guys. For those of you who have not dropped in your website or where you're from, feel free to. We have over 80 people here, so super excited. And we're going to get things kicked off. Amazing. Cool. So I think the first piece is when we talk about these hidden profit killers, especially when it comes to your D2C brand or whatever way you're operating the business you're working with, I think it's really important to start to ask certain questions, right? Which is, and be curious, you guys can answer this in your mind or feel free to drop it in the chat, but how much do you think you're spending on abandoned software subscriptions, incorrect inventory calculations, and inefficient operations? I know it sounds like these could be small things or maybe you haven't thought about it, but it's actually pretty surprising. Dror, I'm sure you see a full lineup of these, and it's pretty shocking, but any other call outs there in terms of how to think about this before we jump in?
No, I think that those are the three main inefficiencies and let's say profit killers for every e-commerce DTC business. Happy to take a deeper dive.
Awesome. So I think let's spend a little bit of time into what it takes to not fix, but also just optimize a lot of these things we talked about. And I think where we can start and maybe just discuss a few different points, right, is like, what does it mean to kind of fix this operation drain that, that we all feel, but maybe don't talk about and maybe don't know where to look at? And I see different brands here from all different sizes. So if you can maybe give a relative scale on like what we've done, and Ben or Rory, we can start either way, and Rory, you can comment from your purview as well. But what are some of these, I guess you can call operational fixes that we can start to work through from a tactical sense? I'll kick it off to you, Ben. Yep.
Yeah. No. I mean, I think one thing that you said, Ron, that's in terms of tactical, like, and actionable items is one, if you've got a Parker, I think or a plastic or a Divvy, really easy to cancel all vendor cards or assign $0 funds to all of them. Because then you start to see just how many apps you've got downloaded. So I mean, that's one really specific one. So last year, let's call it 11 million in D2C revenue for us, right around. We ended up year on year cutting 250,000 in tech stack fees, which is, I mean, just nuts. And that's more of an indictment than like a compliment to us. It's like, well, I don't even know how you're spending that. Which, quick plug for Chargeflow, it's like, hey, you only pay when you win, which is nice. But you've got all these other things that you're not even using or optimizing that are just charging you in the back. So I think, Ron, your advice about just getting rid of everything, or a quick audit that takes 2 hours, you look at every app, and for us, 60% of the apps, it's like, hey, do we actually even use this? Or when you don't know what a quarter of the apps are, I mean, that's a problem. So again, that's on us. But I mean, that's the exact dollar amount that we ended up cutting year on year. And I'll leave tech stack really quickly just because I have the numbers off the top of my head. Agency fees, those are other ones that can creep up when it feels like, to me, the macro environment in D2C was first generalist, and then everything's a specialist. You need a retention agency, you need a creative agency, you need a performance agency. It ends up adding up, a CRO, and we ended up cutting year on year 360,000 in agency fees. One, And that wasn't necessarily getting rid of or replacing all of the agencies. It was just a quick conversation saying, hey, we're not getting actual ROI on this. We need you to be here if we're going to keep moving forward with you. If it either is reduced hours or performance-based plan that gets everyone aligned. So just quick conversations that were pretty honest and candid. So we cut 360,000 there. Then payroll was the other one. And I know none of these are the points that you're talking about, but I'm saying for a business that's 11 million in direct to consumer, so not wholesale, which isn't that big. And we found, and then 500,000 on payroll, where they're just really redundant roles that weren't value adds. And it was really difficult, but when you look at it and it's like, hey, at the same way that you're analyzing, and I know it sounds like a mercenary, but for us, when you look at it the exact same way as the tech stack or agency, does this person, does Ron, does Ash, does Blake have ROI? What are they doing? It becomes pretty black or white. And so those were the things that we needed to clean up pretty immediately. Then you find 1.5 million and it's like, hey, you go chase top line again in a environment where CPMs and CACs or CPMs are higher, so you can have a higher CAC. I think that's something you've said, Ron. The brands that can have the highest CAC are the ones that win. And so it's like, hey, this just freed up, a lot more for us. So all that being said, just putting everything under a magnifying glass. Does it have ROI? If it doesn't, get rid of it. I will get off my high horse and stop talking.
That was awesome, Ben. I also want to kind of jump in here too, because we did something similar at Obvi. Pretty much locked or canceled all of our credit cards, and it forced like a ton of payment declines. When we did that, we saved about 140K a month. So you're talking, over 1.5 million on an annual rate there. And on top of that, what we did is we implemented monthly expense audits. So just every time the books close, we go line item by line item and just determine if this is an expense worth keeping. The issue with doing the monthly expense audit without something like canceling every credit card is any expense that's in this gray area that you're still maybe evaluating the ROI or like, hey, let's wait and see a couple more months. It's easy to just not change anything, right? Where it's hard to like, okay, yeah, let's justify declining it or like canceling it or having that conversation, right? When you actually decline all of these things, it now flips the script where is it worth it to reactivate this charge? And do you actually need it? So I think that's just something, kind of what you were talking about. It's a great way to bring your overhead down. And then what we did after that was also remodel our top of funnel to more of a first order profitability, which is something we couldn't do when our overhead was so high, right? This allows you to maybe focus on higher contribution margin when you know you're not going to get as much volume in, but now with the lower overhead, you actually might be able to become profitable on that online channel. So yeah, wanted to jump in and mention.
That's awesome. Great examples. And I think the piece that you guys are touching on the most, which I think people forget, is like we do this in our personal lives a lot, right? Which is like we subscribe to things, we get different packages and different things that we believe we have under our control. But then a lot of time when you jump into your personal finance, you're like, wait, I still have a subscription to this, or this $16 thing that I'm paying per month. Like, why? Or like these vitamins you signed up for that you don't even take anymore. And you start to realize like that habit, it doesn't fall too far from the tree, right? Because and the truth is we're all humans, we all do it. And I think at the end of the day, businesses, they're not just something that gets shunned from habits that follow. And I think one of the pieces that we've learned is like similar to some of the personal habits we have in our business. There are times where we've signed up or we've worked with an agency or we have these tools that are $199 for the first 30 days, but then we stop using it after 30 days, but it goes to $599, and you're like, wait, I'm paying $600 for what, right? And you're so busy in your day to day, especially if you're a lean team, which I know a lot of businesses have focused on becoming lean, that you forget about these things. So I think it's awesome that you guys touched on that. And I think another example that I would like to jump into is like, there's a lot of people who don't actually understand their true COGS. And I know, Ravi can reference a few times this has happened to us too, but one of the things that I think is like one of those things you need to go and look at today, and I would literally go and check this today, is if you're trying to do an analysis on your cost of goods, or even go and like actually double check your P&L, oftentimes what happens is if you're ordering units at a certain price point and that price point has changed for whatever reason, either you've ordering more your higher MOQ, or you're ordering less, or the freight charge has gone up, or your label price has gone up, or your packaging, whatever it may be. What happens is when you're basically running your books, or you're trying to understand what your true COGS looks like, you often take the most recent price and you kind of hit and apply all, because that's just the standard way to do it. And one thing that we found was that, it starts to make things look a lot better than reality, or you'll start to see values not make sense. And I think until you dig in and take step 2 and step 3 into understanding, like, wait, is my COGS even real, or am I just taking what feels like the most favorable price, but I can't even apply it to an apply all scenario? And I think, a solution there that's been super helpful for us is these things that are categorized as IMS or inventory management systems, or softwares. They are bulky sometimes, and often people are like, I don't need one, I got this handled. But the amount of money you will actually save, not because you're actually cut cost or anything, but just because you've realized that you're looking at true numbers instead of these like arbitrary numbers that you're coming off from, running simple Excel calculations. It makes a huge difference. And then it allows you to set up these monthly reconciliation processes. So again, I know this is the unsexy stuff of operations and finance, but in a time like now where like every dollar counts, especially because acquisition costs are where they are, and a lot of the drain on businesses is like, oh, I gotta find every dollar right now. Start here. Like, start by understanding, do you even have your calculations correctly, right? And I think it'd be good to talk through some of these pieces. And Ravi, if you want to touch on some of the systems and the checklist that we're using, and Ben, feel free if you want to also go through some of your processes if you've done some operational optimization as well there.
Ravi, if I could hop in before you, because
Yeah.
it sounds like you'll actually have the real check. Mine was just for one of the first times and only times in the history of this business made a good hire. And as an investment banker, and I think what made a big difference, Ron, you said things look rosier or better than they actually are. And I think most of the founders that I've met, myself included, are eternal optimists. And I don't bake everything in, where the first thing that he did was really dial in. You're talking about these COGS, where it's like, hey, gross margin, let's have that be a delivered uh let's have that be a delivered line item and cost, rather than a landed or a unit cost. Because I think that's my natural inclination, is to say, hey, it only costs $7 to make this thing, $7.11 out of Vietnam. But it's like, hey, by the time with a 10% return in exchange rate, by the time with duties and tariffs, and those are ever changing landscape, uh, by the time it's really all baked in, it's like, hey, that gross margin actually went from the 74% I was telling everybody to 56, 57%. And there was massive friction for 2 years. And we were lucky that we were in what is it, the ZIRP, the zero interest rate environment, where if there wasn't the cheap debt that there was, we'd be out of business almost totally, because of this disconnect from, hey, this is what our actual CAC can be. You're talking about Ron making first purchase profitability a priority. It's like, hey, it's impossible to, or maybe not impossible, really difficult to hit a target that you don't even know what the real number is, because you're shooting blind. Where the best thing that happened, and it wasn't something complex, it was just factoring in all of the costs that we actually knew: 3PL costs, storage costs, shipping costs, return exchange costs, and that's, yeah, changed the business from barely break even to making anywhere from 15 to 18% bottom line. And I'd say that was the first line item that we really dove into.
Oh, that was awesome. Very insightful too. On our end, like one of the biggest pain points was when we were ordering like pretty much like let's say even like our hero SKU, right? And I'm sure any scaling startup will see this where when you're like in this ramp up mode, you're kind of benefiting off economies of scale, you're getting lower COGS, unit pricing, et cetera. But then just external forces, right? Let's say it's a president election or Meta's not performing well, or maybe Prime Day's coming up or whatever it is, things just slow down and your projections change. They can change overnight. And then you might just start ordering, a lot less quantities and having to upkeep those different unit prices. And the way we would try to do it before is just all on Google Sheets, right? Like we would track it on a lot number and we would try to do like as much of a FIFO method as we can. And we tried so many different processes, whether that was like trailing last 3 months or like last order or a weighted average COGS, et cetera. And no matter how much we tried to like get a handle on it, we ended up seeing a six-figure drift when you looked at our calculated inventory balance based off typical accounting methods, right? What is your inventory purchases minus your cost of goods sold? That should be your inventory balance. When you actually kind of calculated all of our inventory across all of our different 3PLs, we saw a six-figure drift there. And that's what actually made us like, oh, wow, okay, we're at the scale where these drifts are becoming very material and then the fluctuations in our business are impacting this. So that's when we ended up onboarding the IMS that we did. And I think also one thing that you mentioned is just like understanding your true COGS gives you leverage to kind of tackle other things, right? Like when our CMO is asking me what is the COGS on our hero SKU here, so he can adjust the top of funnel or maybe bundles, or maybe even just like a 3-pack and a 3-month pack and a 6-month pack. Even if you're off by like, let's say 5-10 basis points, that can make a material impact when you're thinking you're getting $2 contribution margin per order and it's actually like $1 or less. That can, severely just throw your projections and P&L off. So, yeah.
Something to riff off of there. It also feels like by not having it be a black box, then you can strategically pull levers with each different line item or provider of each line item, where it's like, hey, we just noticed that when it's the fully baked cost of goods and that's all you're looking at, it's like, hey, there's $7 that comes from a manufacturer, and that's where you can have the conversation. I think Ravi, you or Ash or Ron have said in the past, it's like, hey, just offer them an extra, 5%, manufacturer that is, to give you an extended terms. Where I don't think you can really do that if you're looking at everything baked in, or conversely, like with our 3PL, we're getting killed by rates right now, where we've never seen them. It makes the conversation much easier to say, hey, we know exactly how much we're paying on freight. Where when it's an $11.23 box, like black box, it's like, hey, I don't know what's going up or down. To your point, manufacturer economies of scale, but freight, we're not getting that. So it makes those conversations much easier to dial and to optimize.
Yeah. You have to go back and negotiate with your vendors ever so often as you scale, right? Because they want to keep your business, but at the same time, you also need to be with a vendor that can scale. If they're not giving you the preferred rates or the terms you need, you're not going to last with that partnership. Yeah.
Great call outs, guys. And I think, I'm going to actually flip back to the last slide for a second because we covered the credit card piece, which was super important. I think the one piece that you guys all both kind of referenced and touched on was like this comparing supplier invoices, verifying landed costs, etc. I think treating your business as a place that you are the auditor of is super important. Like I think we oftentimes just hope that our accounting team or finance team, and whether it's an agency or an in-house team, is handling it. I think there's also an element of like, whether you're a key operator or part of the C-suite or even part of the executive leadership team, I think having additional eyes from other parts of the business to ask questions actually sometimes brings out what sometimes just slips through the cracks because we're so used to seeing the same stuff. Try to hope for that. Try to ask for other people to ask questions around certain costs. So especially for us, when we're comparing, let's say, supplier invoices, right? I think what we're wanting to understand is like, are we providing a benefit to the supplier in terms of either spending more with them, either as an aggregate or through our one SKU, et cetera? And if that's giving a benefit to them, then is there something we can get back, right? Is it an extra net 10 days? Is it maybe a few pennies off of our point? And I think 5 years in, right, to the business, I don't think I can go back even a single quarter where we haven't gone back to our key suppliers, even our fulfillment and storage company, who probably hates us now, but we've been with them for nearly 5 years, that we're just like, hey, is any way we can save 3 cents? Or can we save five? And when you add those savings up, that over time, it's kind of like the market, right? You just invest a little bit of time into saving a little bit at a time, and it starts to really roll up. So just wanted to really call out, like, don't, and during, especially during this time and what's going on with the macro environment, don't underestimate what you can save with little changes. Don't just go for the big swings.
Ravi and Ron, can I ask you two a question?
Yeah.
So Ravi, you brought it up. So maybe you first. Monthly audit, or maybe Ron, you said it, I forget which one you said it. The monthly audit, is that like a formal sit down? And I'm wondering who owns.
Yeah, I before, like back in the day, I used to make Ash and Ron sit in a room with me and go
Yeah.
through line item by line item. I would literally put it up on like a bigger screen and we just go through it. Nowadays, because they hated, me doing that to them every month, I basically send them a spreadsheet and just make it super simple for them to go through each line item, put their notes in, and then whatever action steps I need to take, I take it from
Yeah.
there. Yeah.
Cool.
We have some questions here, so I just want to jump into it real quick. Iqbal asked, any inventory system? Iqbal, we use Luminous. Ben, do you have any suggestions there?
We know Luminous really well. They're right in our backyard, Jared and the team.
That's right.
We haven't moved over there yet, so that's probably a lift in the next 3 months, and probably Luminous. Fulfill in terms of more ERP type, but Luminous is the one we're looking at most heavily.
Sweet. Tim, I think you made a great call. 3PL visibility is key, and I just want to make one note on this. Like, for your 3PL, don't just take the line item breakdown they're giving you. Ask for more backup, ask for more details, understand what your true cost is, because there's a lot of like oops moments we sometimes catch, and it's like, oh yeah, sorry, didn't know where that came in from. And it's not really hidden fees or hidden costs, because I don't think anyone operates in that type of manner, but there are little things you'll find and you're like, wait, this doesn't make sense, I shouldn't be charged for this, or what is this cost and how can we remove it? And I think we've been able to find ways to just optimize things like that. So and Kev, question you asked, and I'm curious your thoughts, Ravi and Ben. Any recommendations on when or how to negotiate with vendors, time-based, annually, or at a certain revenue trigger? Any thoughts here?
Yeah, it's kind of a combination of both, right? You're gonna want to do it every quarter, every 6 months at a minimum. But at the same time, if you are seeing explosive growth, that's also another reason to go back to them, even if that was just like, 2, 3 months ago. They always want to keep business with them. And especially if they see you guys scaling, they will also see the long-term plan. So you have the leverage in those moments. So I would say, like, time-wise, no longer than 6 months, but if you are aggressively scaling, leverage that.
And the last call, I mean, Brian, nothing against ShipBob. Again, I know a lot of people there, but yeah, it's tough. These costs are high. We've been out of 3PL for the same one for 4 years, and we've gotten to a point where we've negotiated out our storage costs, any pallet costs, as well as negotiated out any cost for returns or exchanges. So like, we're down to just pick and pack plus the cost of shipping. And we're at a rate where we're like, okay, this is digestible, and then we go back every quarter to save a couple more pennies. So again, if you guys are looking for a 3PL or anyone, just feel free to, anyone on this webinar here will be happy to give you guys any recommendations of things we're using. But with that note, I'm going to continue on because I want to get into some of the sales leaks, right? And I think this is the piece where, like, this was probably something that we ignored for a long time. But then when we got into it, we kind of got get addicted to it. And you're like, holy shit, this is like a huge thing that you ignored and now has saved so much money. So let's jump into chargebacks. And I think for those of you guys who just looked at chargebacks as a category and just wrote it off to what it is, to break it down, when a customer files a chargeback, you're hit with not just the original purchase amount. So if someone buys something for $60 on your website, yes, you're going to be paying that out. But then you have a chargeback fee, which is sometimes $15 to $100 per incident. And you have processing fees, which you don't get back, which is at 3%. Shipping costs, right, which you have to eat. Lost inventory, which you have to eat, which is your cost of goods. And then employee time fighting that dispute, right? You have someone writing back and forth, following up, trying to win it, find out they lost it. And it's like, all right, we just got hit in 6 different ways on somebody saying they don't want to pay for this, right? And it's like, again, many of you may say, oh, it happens like 1% of the time, 2% of the times. But when you look at the composition of that 1 or 2% or even 3%, whatever your number percentage is, when you compose that into, wait, you're getting charged in 5 or 6 different ways on that 1 or 2%, that's when you realize, like, wait, this is a lot of money. And so I want to kind of jump into Ben, Ravi, you guys can talk through a little bit of like this dilemma and kind of what we felt and how we use a tool like Chargeflow, which has been incredible, but maybe give some of the viewers a little bit of lens into how that decision came and what was some of the benefits out of it.
I can do this one first. Yeah, specifically our journey with Chargeflow. I want to say we were pretty early on, and it was just because we were sick of chargebacks. And when we went from 2.1 to 6.7 million in revenue, and chargebacks took like an unholy amount of time. It was I couldn't believe it. And Ron, you were saying the traditional way is you pay someone on your CX team. We're paying them $17.50 an hour, $15 to $17.50 an hour. They go in, they take screenshots of actually the order and then of the shipping info, and really archaic way. And this is the one time, and again, I'm not putting the ball in Shopify's court, but that was one where I felt like there's disconnect where I thought Shopify kind of let us out to dry. And it just took a lot of time, and we never won any of them. It felt like, even though we did this manual process, where I think our win rate on these disputes was somewhere between 25 to 30%. With Chargeflow, the past 12 months, our win rate is over 70%. And I'm going to be honest, and this is why he's on the call. I don't actually know what we pay. Maybe this is why I need Ravi to run us through the monthly audit. But I know you only pay when they win, which is, hey, that's the most alignment I've ever seen out of any SaaS provider. And it's a totally hands-off process. They win more cases than we do, and our CX team doesn't need to deal with it. So that's been our journey with Chargeflow, and it's the one vendor we are not planning on churning from because it's a totally thoughtless thing.
Yeah, and even on our end, like we were a very lean team, especially prior to onboarding Chargeflow, which was back in 2023. We were even leaner. All of the disputes and chargebacks were on me. So I had to go into each different like processor, whether that's like PayPal, Afterpay, JP Morgan, like whatever, and spend time doing it. And honestly, like when you're just tackling it as a side project, you're not doing it justice, right? I'm just kind of like throwing in the tracking, like hoping for the best. Our win rate was probably like 30%. Like it wasn't even anything great. And you would spend so much time on it. And then after like we onboarded Chargeflow, I think just like last year alone, I was like looking at the dashboard and it's like you saved over 400 hours, and like forget even just the financial recovery aspect, like that's huge to me. The fact that I just didn't have to spend that time when I could have, put that time towards more material things for the business. Our win rate's like closer to I think 85% at this point, and then I see on the slide it says 27K. I think we're honestly closer to 40 just last year alone. So yeah, I mean, and then also the fact that like, Ben, you mentioned it, right? Like this is incremental added top line and bottom line for you. You're not paying a retainer fee for these guys. They only charge you a commission if they win back that deduction or that dispute. And so it's just it's almost like a no-brainer, right? It's like you're not paying anything up front. You only pay them when you win, and you just see an extra, call it a few thousand in your bottom line, depending on your scale, which you can start putting towards agencies or even finance fees to help cash flow. Like it really, like that benefit just starts to compound. with what else you can do with it.
You would have onboarded with Chargeflow a lot faster if you made Ash be the one disputing all those in
Yeah.
years past. Yeah,
Or
that's
if I,
yeah.
or if I had Ron do it, 100%.
Yeah.
Ravi, how long did it take you to process one dispute, if I may ask?
It depended on which platform, right? But it would take me like a few minutes to do each one. So like let's call it 2 to 3 minutes, and we're getting like dozens, if not hundreds, of each month.
Yeah.
And that
Yeah.
too, it took me 2 to 3 minutes because I was not giving it the proper time. I was just grabbing the Shopify link, grabbing maybe some conversation between us
man.
and the customer, uploading it, right? And then just I don't even check if it won or not, to be honest. Like I just kind of hope for the best after that. So yeah.
Yeah, and it's interesting because that I mean chargebacks it started way back in the 70s as a mechanism to protect buyers from identity theft or credit card theft, and now roughly 80% of all chargebacks is what we call in the industry friendly fraud or unfriendly fraud, which is basically people who abuse the same system to get free stuff at the end of the day. And it's interesting that both Ravi and Ben, I mean, you guys choose to fight, but we also see a lot of merchants that they say, okay, I'm not going to take action against those buyers. They say, it's extremely cumbersome. You were talking about inefficiencies, and a good question that I have for you is, did you see any attrition within your team as a result of processing chargebacks? Because if you don't have the expertise and you're just grabbing a few screenshots, putting it together and sending it to Shopify, then you're likely not going to win. And talking to merchants, they're telling me, hey, my CX team is extremely suffering, and they're frustrated because they're doing the same action day in, day out. They do not tend to their core tasks and responsibilities, and then they leave the company. So it's another point that's worth mentioning. I don't know, Ben, Ravi, did you guys see it within your teams?
Yeah, I mean, it takes a toll, right? Like spending so much time on like what is considered a menial or tedious task,
Yeah.
morale, motivation, efficiency, like everything kind of takes a hit. And again, like it's like even to me, I looked at it as fully just a side task that I just had to do, right? I didn't look at it as, okay, what's the actual impact I can get from it if I handle this like properly? It was just something I had to do just because I was told to do it, right? So yeah, I mean, it definitely takes a toll.
Yeah, and you chose. Go
Sorry,
ahead.
go ahead.
Sorry.
No, continue, Drew.
No, and one of the things that we witness when we jump on onboarding calls with clients, we have 15,000 merchants working with us, and we try to talk to as many as we can. And when we jump on those calls, and I'm very surprised to see that merchants treat this as shoplifting or runoff. They say, hey, it's like a crate of wine that fell from the back of a truck. This is the cost of doing business in the United States. And the reason why they're saying this is because the Visa rulebook is this thick, right? And it's extremely cumbersome to understand how exactly you need to apply to those chargebacks if you want to win anything. And even if you do understand the Visa rulebooks, then the content keeps changing every 4 months. So you also need to be updated. You need to make sure that you understand the guidelines. And even if you are updated and you know what you need to say, just building that intricate representment, presenting the correct evidence, having the right verbiage, which is pseudo-legal, in my humble opinion, it's extremely cumbersome, and this leads to, I would say, the vast majority of merchants that come to us and work with us, they just don't handle it. So kudos to you guys, Ben, Ravi, for doing this from the get-go. We're talking about a problem which eats up $316 billion every year. And Ron, as you mentioned before, a lot of people that I talk to, they're saying, okay, so disputed amount, bottom line, loan, but they forget everything that we mentioned before. On top of that, personnel costs, fees, hidden fees. Not to mention that sometimes if you have a very high dispute rate, you might get into monitoring programs by MasterCard and Visa, and that can put a reserve on your account, and that will increase the fines that you will get, and that can also lead to termination of account at severe cases. So it's very important to be very mindful of the entire chargeback situation and to break it down and understand what's eating your profits and revenues, but also be very mindful to the high level overview of chargebacks within your organization, I would say.
So I think I want to go into a couple of questions that I got in.
Mhm.
Connor McDermott mentioned, have you ever considered duty drawbacks as a way to optimize costs when shipping internationally? I know for us, we use open border and they process things a little bit differently there, but just wanted to open that up to the floor. Dror, I don't know if you have any comments there, or Ben, any experiences, or Ravi, but anything on that one question there.
I'll defer to you here, Ravi.
Yeah, I mean, like Ron said, we use open border, and one thing that's great about them is they price in all of these things into the international stores. So our, let's call it net margin or contribution margin on an order is more or less the same as it is domestic, and they pretty much handle like that pricing, those like incurred fees, and then what is the most optimized like shipping or carriers to use. So it's, yeah, just honestly, it's not something that we've been super involved in. It's something that they've kind of like white gloved handled for us. Um, so yeah, like I wish I had more insight on that, but it's just something that open board is kind of really taken over for us.
Fair. Awesome. So I think you guys mentioned a lot of great things, and I want to jump into a little bit more around this idea of the true cost of a standard return, right? Which incorporates the original shipping, the return shipping cost, processing both ways, customer service time. We talked about, also repackaging and restocking costs if your 3PL is charging you for that, and then additional shipping supplies, right? And then when you kind of take that into from a data point, right, and understand um, why this is happening and what are the components of a return, right? You can kind of start to see patterns. And I think, Ravi, if you want to jump into kind of what we saw at Obvi, I think this would be a good place to kind of see how others can maybe look at some of their return rate patterns and what they can do to mitigate some of those um, elements.
Yeah, it's like for Obvi at least, our return rate is roughly 1% when we look at percent of gross revenue on the D2C site. I know like after implementing no fraud, they just have a better system of detecting fraud and not letting those go through. But then also approving things that might be like considered fraud by Shopify, so they actually process like uh, proper orders. I would say that um, sorry, I just blanked out on where I was going with this. Um, Ben, if you want to jump in
No
while I
problem.
try to catch my thought.
Yeah, happy to. I mean, I don't know if I can help you find a thought, but
So,
oh,
yeah, go
go
ahead.
ahead.
Sorry about that. Okay, so I think the one piece that I think is important to kind of go through is like when we're looking at the reason why somebody is returning, right? Or wants to charge back or wants nothing to do with the product they bought, right? I think some of the pieces that we start to look at is, all right, is this customer coming from a certain SKU, right? And you start to flag that SKU. And then if you look at, well, in how much time are they doing it? Because we'd sometimes see our burn product, which is a weight loss SKU, get a lot of people saying, hey, I want to return this. And it'll be like 4 days after they receive the product, which means they haven't even probably taken this product more than 3 times, right? And then you understand, oh, wait, it's weight loss category. It's less than 7 days since their product arrived. And it's a cohort of customers that came from TikTok Shop, and the reason is the product didn't work, right? And you start to understand these patterns, and I think you can start to see how can you go up against your return rates instead of just trying to give out refunds to people or kind of salvage what you can get out of it. So I think finding these sales leaks through data points is a super important element that we started adding and started to pick up on from a data side as well. I'd love to jump into the red tape tax. And I'm sure, everyone has their own experiences from it. But here's a scary number. There's over 13,000 sales tax jurisdictions in the US alone. Most states now require you to collect sales tax if you exceed certain thresholds, usually around 100,000 in sales or 200 transactions in a year. And first of all, it's surprising to see how many businesses don't even know about this. And then when they do find out, it's usually because they've been penalized or got some sort of notice in the mail that they didn't follow the jurisdiction. So I think another piece that I think is just to get ahead of, if you can, when it comes to some of these leaks out there, is track your sales by state and then understanding your nexus obligations to know within this one jurisdiction, what do you really owe? And then having the right tools or extras in place to handle that collection and remittance, I think is super important. But any other comments, Ben or Ravi, particularly from you guys, on this tax piece that you guys have learned either the hard way or certain things you guys are doing that could be insightful?
Yeah, I can do this one in 15 seconds. Big fan of numeral, where we were with Avalara, and it seemed like and I own part of this business, and I was like, oh my gosh, I'm gonna go to prison in 11,000, 13,000 jurisdictions. It's like Chicago is broken up into 14 jurisdictions in its on its own, and you'd get a letter every week, and it's like, hey, here's you owe us $10, and it's like, anyway, it's been nice to have a lot less stress because you get the letter. You're like, is this real? Is this not? Have we reached Nexus? Have we not? And there were a lot of question marks, and taxes are one of those things you don't want to mess with. So numeral has been really, really awesome, and I highly recommend that team.
Yeah, no, we use numeral as well, and then we started using Kintsugi, which is like pretty
Oh, yeah.
much a very similar model as
Yeah.
numeral. And the one thing that like the biggest thing here is a time saver for the personnel handling the state sales tax prior to onboarding a software like that. So again, like it was pretty much just me and my analyst taking a stack of, call it 30 letters that we would get every week from all these different jurisdictions saying this is what you owe, these are some interest and penalties accrued because you didn't pay it on time, et cetera, et cetera. Now, like after you onboard like a solution like that, these letters probably get down from 30 to like maybe 3 to 5. You don't even have to address them. They pretty much, the solution will automatically address it, automatically understand when you're hitting Nexus, either based off revenue or quantity of orders, and they just handle everything. So that, like, call it maybe hour task that I was doing every week became a 2-minute task, just like getting an email from them saying, hey, you have 20 filings to approve, clicking a button, seeing how much is owed and when it's going to go out, and then just approving it. And then not only is it just quicker, but then you have more visibility into like those cash outflows. Whereas before, when you're kind of doing this manually, or maybe you're hoping like your accounting team will take care of it, you don't really have like proper visibility into how much is owed into each state and when those payments are all going to be deducted from your bank account too.
Awesome. Awesome. I think let's go into what is something that is, again, I feel super, super critical, and especially in this time period, is the finance stack trap. All fast growing brands need financing. I mean, we've used financing from year to year, month to month, and quarter to quarter. But I think there's a lot of these fees that people ignore and forget about and don't even know what they mean. So I think this is probably another critical piece to kind of go through. And we've listed out here some of those phrases that you'll catch a lot across these financing tools, whether it's origination fees, interest rate variations, processing charges, banking fees, early repayment penalties. I want to just spend a minute maybe across these. And Ravi and Ben, maybe you guys have different experiences across these ones. But I personally, I'll give my experience on one of them, which was the origination fees. And I think I talked to Ravi about this on a line that we recently took out. And I was like, what is this like fee? And it was like, I think it was like $15,000. And he was like, oh, this is to originate the loan and the document and the paperwork. I'm like, originate, this is all digital. Like, and then you're wiring me money. What are you originating, right? And the thing is everyone has a cost to cover their time that they're putting, and the way that they label how their cost of goods looks is for finance companies, it's origination fees, and that's really for them to cover their costs and their time. And I think there are ways to negotiate this always. So don't just look at some of these things as face value and say, oh well, this is just what it's going to be. I think right out of the gate we negotiated it And we also said like, hey, if we don't end up using this loan and we work towards another one, we want to be able to use this origination fee that you're not refunding as a credit next time we want to move to it. So I thought that one was interesting. Ben, Ravi, if you want to comment on some of the other ones and call out any specific scenarios, I think it'd be super helpful for people.
Yeah, no, I think the finance stack, like we can look at it as just like your basic stack of credit cards, and then you're probably your working capital solution or long-term debt. On like the credit card thing, it's really just a function of what is that processing fee, like processing fee to use the card. Usually, typically you'll see like a 2.5 to 2.9%. Some of these cards, especially if they're offering like very high float, they might even tag on a surcharge on top of that. And then some of these cards that might be having very low float, you have the cashback aspect that you can actually just kind of put net effective against your processing fee, right? So let's say you're using a credit card that's giving you 2% back and you know it's charging you 2.9%. I consider that as a net effective 0.9% fee to then get whatever float that means for that credit card. And then on the debt side, it's so with that, the origination fees, you'll typically see that with just traditional lenders or ABLs. And that's just something you have to look at the entire structure as a whole of all of the expenses you're going to be paying and what that and how that'll impact your P&L, right? Because they'll entice you with a low APR. You'll get like prime plus maybe 1 or 2%, but then they'll hit you with these origination fees, maybe even a monthly monitoring fee. Maybe every time you pull on the debt facility, it warrants like a warrant or even like an additional fee there. So there's all of these like tiny things that you just need to consider. And I think looking at it as kind of like net effective, what is the total cost that's going to be hitting your monthly P&L is the best way to analyze like the cost of capital.
Yeah, one of the biggest things we cut was, interest expenses. And that's an element of growth where you can transition from MCAs to kind of the quasi amplas to a bank, kind of more traditional financing. And again, you got the wrong guy for this call, or Mark, the investment banker that made all the changes. He could talk to this much better than I could. But to Robbie's point, and similar to the P&L, the biggest thing was outlining every single, almost comparing. I did the same with my personal mortgage when I was getting my home. You outline every single line item, just like a P&L on any debt facility. So you can compare real apples to apples, because it's like, hey, I saw, a 1.8 million big number, top line number, if you will, from Wayflyer, but it's like, hey, there's a lot of fees baked under versus a Dwight funding or on the ABL side. And so just lining them side by side makes a big difference rather than going after whatever the biggest top line amount is, because there's a lot of things that are under the hood that we found out in terms of origination fees and whatnot. And it feels like a lot of these, particularly more neobanks or lenders, have a little bit more flexibility there if you push. So
awesome. Great insight, guys.
Ron, just
sorry.
one quick note from my end, if you can just go back to the previous slide.
Absolutely.
Yeah, so you're talking about monthly charges, and we're talking about processing charges, which is something that you can predict according to your marketing efforts and a previous month or previous season sales. But it's extremely important to note that processing charges are dynamic, and sometimes it can get direct impact from the percentage of chargebacks and how you handle chargebacks. The more chargebacks you have, the higher the dispute ratio is, the more money you pay with processing charges. So it's not just bottom line recovery and all the other areas of impact that we talked about before. We need to understand that processing charges are basically dynamic, and they are directly affected by how your business is treating chargebacks and how aware you are of the chargeback situation within your account. So it's extremely important to be on top of things and make sure you check that regularly, just to make sure that you're not exceeding the threshold of a Visa dispute monitoring program or Visa fraud monitoring program, just to make sure that you're always beneath the threshold that will increase the processing charges.
It's a great call, Jordan. Thank you. Amazing. I know we're coming up to wrap up, so I just want to call out what sometimes feels as obvious. But before we jump into Q&A, just want to make sure, like, when it comes to proper financial strategy, make sure you're not taking on financing without clear ROI targets. You're building cash reserves in good months, not just using good months to be able to spend more in different places, although diversification is important. And then make sure you're tracking the true all-in borrowing costs. It's super, super important, especially with all of the line items we just went over in terms of the costs that do get incorporated. And then always have an exit plan, not just for your business, but also for different costs that you're taking on, different tools you're using. It's important to understand, like, what is the goal of this? How far is it supposed to get you? And then how will you get out of it, right? So without further ado, I do want to spend the last 5 minutes with Q&A. There's been a ton of questions thrown in here. Let's start with one that I'll read out, which Jordan mentioned, which is an interesting one, which is, where else do you get chargeback besides Shopify? Doesn't Shopify automatically notify you of chargebacks and take care of them if they're challenged? Dror, Ben, Ravi, I'd love you guys to jump in here.
Well, they will notify you, but they will not take care of the chargebacks. They will tell you, hey, your buyer submitted chargeback, please take action. And you have a limited amount of time for you to respond. If you don't do it, then you lose. Same with Stripe, by the way, and other PSPs.
Yeah, and then I know like I've had to go into like the PayPal dashboard, the Afterpay dashboard, even like Maverick dashboard, and actually do the chargebacks there. And then, so yeah, I think you'll get hit pretty much on every processor you use.
Every processor, hands down.
Incredible. Another question that we had gotten was, when it comes to chargebacks, are there certain ones that you can start to block based on the pattern that you're learning, or certain types of customers you can block based on the pattern, or do you have to handle each chargeback separately as it comes in regardless?
I can take this. So if you're using Stripe, for example, you have Stripe Radar, which is a tool that's aimed to micro-configure your gatekeeping rules, saying, okay, for example, I do not wish to fulfill orders for high-risk buyers, for example. It's very risky because you're basically playing around with your conversion rate. We have a solution or service that can help you monitor this and make sure you optimize your gatekeeping rules. In addition, what you can do, this is something that you can also do within our platform. No need to do actual recovery if you guys, or if any merchant doesn't want to do this. We keep track of what we call repeated offenders. Every merchant, unfortunately, has repeated offenders, repeated disputers. We can identify these. And I would say that I haven't seen a single merchant that doesn't have 10 or above repeated emails, repeated phone numbers, users who basically abuse the service. And once you surface and highlight those, then you can just block them from your end. And this is something that you can feel free to go to chargeflow.io for the masterclass. Use OBV as a coupon to get your first 100 chargebacks for free. But if you don't want to do it, you can just enjoy our insights, which is a free for life product. Identify those patterns by email, phone number, address, and then within your order platform, just block off these users if you want.
Amazing. Brenda, I think you raised your hand. Feel free to drop in the question in the chat and we'll answer it. Bruno asked a question regarding chargebacks. Can we check in Shopify, payments, Stripe if we are reaching the threshold? Thank you. Dror, do you have any comments on that? Which is, can we check in? Yeah, regarding chargebacks, can we check in Shopify payments or our Stripe account if we are reaching the threshold?
Yeah, so Stripe has a built-in feature that allows you to keep track of the dispute ratio. And I think it's 0.6 and 0.9 are the two tiers that they have. I'm not sure, you have to validate that. Within Shopify, it's a matter of simple calculation, chargebacks divided to transactions that you have. And that way you can understand the situation within your account. You have two main programs, Visa, VDMP, Visa Dispute Monitoring Program, and Visa Fraud Monitoring Program, and MasterCard also have a program. There are thresholds there. If you exceed it, you'll get an early warning email, and then you'll be placed within the remediation plan for 3 months. If you take care of your clients There are steps that you can take. Maybe we can have another discussion about that. Proactive steps that you can take specifically within the service space of your business to prevent chargebacks from happening, and also some micro adjustments that you can do and implement within your existing processes to make sure that once those chargebacks happen, you have all the evidence you need to recover the chargebacks after they happen. So two different spaces. Ron, maybe we can talk about it at another time, but there are definitely steps you can take.
Absolutely. Well, again, we've left all of our contact information here. Ben, if you want to pop in, put in any information, feel free in the chat. But first of all, thank you guys all for sticking around. Hopefully this was valuable. We plan to turn this into a series and continue to bring more information to you guys. But thank you all for joining us. Feel free to reach out if you have questions. And until next time, Ben, Ravi, George, thank you so much for your guys' time, especially on a Tuesday afternoon in Q1. So really, we appreciate it, guys. Have a wonderful day, and good luck for the rest of the week.
Thanks, everybody.
Thanks,
Thanks,
everyone.
everyone.
Hey, guys.